Have you ever wondered where money truly comes from? Not the bills in your wallet, but the invisible ocean of wealth that moves our world. What if I told you this ocean isn't controlled by governments or the people who earn it, but is created, almost out of thin air, by the very institutions we trust to protect it? This is the story of modern banking, a silent heist that happens every day, right under our noses. You deposit your money into a bank, believing it's safe, locked away for you. But your money doesn't just sit there. The moment it enters the bank, it's lent out, invested and multiplied in ways you can't imagine. The bank keeps only a tiny fraction on hand. The rest becomes a digital promise fueling a global machine designed for one thing: profit. In the relentless pursuit of profit, the seeds of crisis are sown. Financial crises aren't random acts of nature, they're man-made disasters, the predictable outcome of a system that rewards excessive risk. From the Great Depression to the 2008 meltdown, the pattern is the same: prosperity built on easy credit, followed by sudden collapse. Homes are lost, jobs disappear, lives are shattered. Each time we ask, how did this happen again? The answer lies in the very mechanics of banking. Is the system broken, or is it working exactly as designed? Are these crises accidents or features of a system built on debt and risk? To understand our future, we must journey back in time. We must uncover the origins of this powerful system. Only by understanding how this silent heist began can we hope to comprehend why it continues, over and over again. The story of money is the story of trust and betrayal. Let's follow the ghost in the machine. Our story starts with gold, heavy, scarce, and universally valued. Carrying it was risky, so people turned to goldsmiths for safekeeping. In exchange, the goldsmith issued a paper receipt, a promise, a claim on the gold. Soon people began trading these receipts instead of the gold itself. The goldsmith noticed most gold just sat in the vault. Rarely did everyone redeem their receipts at once. He realized he could issue more receipts than gold he actually held, lending out these new, unbacked promises and charging interest. In that moment, money was created not from metal, but from debt. A ghost was born. This was the birth of fractional reserve banking, keeping a small reserve, lending out the rest. The goldsmith, now a banker, earned interest on money he never truly had. This new power fueled economies, but it came with a hidden flaw. If too many people demanded their gold at once, a bank run, the system would collapse. The paper promises would become worthless, and those last in line would lose everything. This vulnerability, born in a goldsmith's workshop, remains at the heart of our financial system. The ghost he created has grown into a giant. Today, the same principle underpins the global economy. Money is trust, but also risk. The system's strength is also its greatest weakness, and the ghost still haunts us. Fast forward to today. The goldsmith's workshop is now a skyscraper. Gold is gone, replaced by digital entries, but the alchemist's secret, fractional reserve banking, remains. Deposit $1,000 in your bank, and only a fraction stays in reserve. The rest is lent out. That loan is deposited elsewhere, and the cycle repeats, multiplying money throughout the economy. This new money isn't printed by governments, it's created by banks every time they issue a loan. It fuels mortgages, student loans, business ventures, driving growth. But every new dollar of money is also a new dollar of debt. Our financial world is built on an ever-expanding mountain of debt, requiring constant growth to stay stable. The system relies on confidence. Borrowers must repay, and depositors must not all withdraw at once. Banks chasing profit are incentivized to lend as much as possible, pushing the system to its limits. This creates a powerful temptation to lower standards and take on more risk. The magic of money creation is also its danger. When trust falters, the system can unravel. The ghost in the machine is always hungry, and the cycle continues. Picture the financial system as a house of cards. Each card a loan, mortgage, or complex product. At first, the base is solid, but as banks chase profit, they use riskier cards, subprime loans, bundled into mortgage-backed securities. These risky bundles are sold worldwide, labeled as safe. In the run-up to 2008, caution was abandoned. Loans were handed out to almost anyone. Banks quickly sold off these risky loans, passing the risk to others. Credit rating agencies, paid by the banks, gave these toxic assets top ratings. Everyone made money, and the house of cards grew taller. Leverage amplified the risk. Banks bet huge sums with little of their own money. A small drop in asset values could wipe them out. The whole structure was built on the belief that housing prices would never fall, but no market rises forever. When homeowners began defaulting, the cards at the top started to wobble. The breeze had arrived. The world was about to see the house of cards collapse, and the fallout would be global. In 2007, cracks appeared. Mortgage-backed securities lost value as homeowners defaulted. Panic set in. Banks stopped trading these assets, unsure of their worth. Trust evaporated overnight. The frantic music of buying and selling stopped. Banks were left holding trillions in assets they couldn't sell. Highly leveraged, even small losses wiped out their capital. The ghost money vanished, leaving a black hole of debt. Bear Stearns fell first, then Lehman Brothers, the largest bankruptcy in U.S. history. If Lehman could fail, anyone could. The web of connections meant one failure threatened all. The global financial system froze. Credit markets seized up. Banks refused to lend, even to each other. Businesses couldn't get loans to pay workers or suppliers. The house of cards was collapsing, and the world watched in horror. Lehman's collapse triggered a global chain reaction. The problem, a shadowy market for credit default swaps, insurance on risky assets. AIG, the insurance giant, had sold billions in swaps, insuring collapsing securities. When Lehman failed, AIG owed more than it could pay. If AIG collapsed, every major bank would suffer catastrophic losses. Governments intervened, orchestrating massive bailouts to stop the dominoes. Trillions in public money propped up failing banks and rescued AIG. The argument: save the economy from a second Great Depression. But profits were privatized, losses socialized, bankers kept bonuses, taxpayers paid the bill. The crisis spread to the real economy. Businesses laid off millions, spending plummeted and household wealth evaporated. The financial crisis became a global recession. The domino effect had jumped from Wall Street to Main Street. For ordinary people, the crisis was a human catastrophe. Families lost jobs and homes, even if they'd done nothing wrong. Foreclosure signs became the symbol of shattered dreams. Generations of wealth vanished in months. Retirement accounts plummeted. Futures were stolen. Young people graduated into a bleak job market burdened with debt. The crisis created a lost generation, their potential scarred. Few banking executives faced consequences. Fines were small, and the system remained intact. For millions who lost everything, the lack of accountability was the bitterest pill. The sense of injustice lingers, a system rigged for the powerful. After 2008, the world demanded change. Politicians promised reform. New regulations like Dodd-Frank were passed. For a moment, it seemed the lesson was learned. But profit's pull is relentless. The financial industry spent billions to weaken and repeal regulations. The memory of crisis faded, but risky behavior returned. The business model, creating money through debt, using leverage, remains unchanged. Today, global debt is higher than before 2008. Risky lending and speculative bubbles are back. The biggest banks are even bigger, making too big to fail worse. The system's core conflict remains. Banks seek profit, but stability serves the real economy. Until we resolve this, we're just resetting the clock for the next crisis. The lesson remains unlearned. We're left with a system seemingly destined to repeat its failures. From goldsmiths to global networks, the same ghost haunts the machine. Debt, leverage, and profit drive a cycle of boom and bust. Each crisis brings regret and promises of reform, but complacency returns. Defenders say risk is the price of progress, but they ignore the human cost. The next crisis may look different: corporate debt, crypto, or something new. But the mechanics are the same. Our interconnected world means a spark anywhere can ignite a global fire. We've built a magnificent, unstable structure. Are we trapped in this cycle, or can we find the will to redesign the system? The answer lies not in boardrooms, but in the choices we make and the future we demand.